So hi everyone, thank you all so much for taking the time to be on our webinar today. I'm excited to be able to go over this topic with you folks, as this is something that we focus on every day for our clients. So how to buy investment property. So during this presentation, I will be explaining what we do as a company to help our investors buy and manage investment property. We have a large database of clients who we have helped acquire property locally here in California, as well as out of state, and I'm going to share our process with everyone here today. So my name is Vince Tomich. I'm an advisor here at Marshall Reddick. My primary role as an advisor is to learn as much as I can about each individual investor and to help guide you through the process to achieve your investment goals. A little bit more about myself. I was born and raised here in Southern California. I have been in the real estate industry for over 5 years now. I am an investment property owner myself and definitely plan on continuing to grow my portfolio as quickly as I can. Prior to my role as an advisor, I was a mortgage lender for a number of years, and that's where I learned the value of leveraging money. So I realized that investing, especially in my market of Southern California, was very difficult. But when I was introduced the idea of investing out of state, coupled with understanding financing, is what made my goal of being an owner very possible. So I'm super excited to be able to share that with you guys and go over that process and how we can help you folks do that as well. So a little bit more about Marshall Reddick. I know there's probably a few of you that have been to our webinars in the past. I know that there's definitely a handful of new folks here. So this is always a good opportunity to explain who Marshall Reddick is and what we do. So Marshall Reddick is a full service real estate firm, and we have 3 primary services that we focus on. Those being real estate brokerage, property management, and private lending. So for our real estate brokerage, we help people buy and sell property, whether that be primary or investment. For our property management, right? 99% of the people who buy an investment property are going to need property management. So what a property manager typically does is, everything on behalf of the owner, and that entails, marketing the property, getting the property rent ready for new tenants, right? Doing turnovers, any kind of rent collection, rent disbursement to the owners, any kind of repair requests. Also, end of the year tax filing information, right? So being able to provide 1099 so that you can bring that to your CPA and get all the tax stuff in order. So our property management team would be able to handle all that on your behalf. And then our third service is private lending. Private lending is a super unique and niche service that we offer. So there's actually 2 clients in private lending. You have your borrowers and then you have your lenders. So to give you some example of borrowers, some of our borrowers may include those looking to invest using their self-directed or self-directed retirement account who want to buy property. So you need what's called a non-recourse loan, and you can't, your typical conventional lender cannot offer that. Also, there's your fix and flip people, right? So people who are looking to buy and rehab a property and sell it for a profit, or maybe refinance out of it. That's another, typical borrower for us. And then on the flip side of that, we have our lenders. So the same way that you can invest in real estate, we give our investors the opportunity to invest in mortgages. So those are first lien mortgages, and those go anywhere from 12 months to 30-year fixed, and interest rates or returns on your side is going to be anywhere from basically 6% to up to 12%. So my goal is to make the process of investing as seamless as possible by educating and introducing all the key players that work with us to make this happen. So regardless of what service may be applicable to you, we most likely have a home for it. But today we are going to be going over more of the investment property purchase stuff. So topics we're going to cover. So here's a list of topics that we are going to go over today. These are all important steps in the process, and if there's anything specific that someone would like to focus on, I will be doing follow-up calls, and we can go over these items on a one-on-one basis. But just to give you a quick rundown, we're going to go over investment criteria, how to do your due diligence. We're going to go over some calculations and formulas on our live examples. We're going to go over financing and options to leverage, property management, and then as well as some of our locations. Now, some of you may be asking, okay, where do we begin? How does this start? Well, it all starts with a conversation with an advisor like myself. So there's multiple advisors in the company, but what you would do is set up a call with us, whether we just call you back from this presentation or if you want to set up an email. But this is an opportunity for us to learn a little bit more about you and what you're specifically trying to accomplish, right? So we're going to go over a little bit of what that call may look like. So this is kind of a good way to I guess, explain what our initial call is going to look like. What we want to do is figure out the who, what, when, where, and why, right? So we want to figure out, why are you looking to purchase, right? Why are you looking to buy an investment property? Is this maybe for cash flow? Is it for appreciation? Is it for taxes, etc., right? What is the reason? 2 is how. How do you want to purchase this? Is this going to be a cash purchase, conventional, private loan, 1031 exchange? So there's multiple options, and we want to figure out the best for you. When is also important. There's folks that are ready to go right now, maybe the end of the year, maybe there's something pending that you guys are, that's going on in your life that you have to wait for. So we want to take timing into consideration as well. What type of property? Are we going to do a single family, a multifamily? So that meaning, 2-unit, 3-unit, 4-unit, 10-unit, right? Whatever's kind of in line for what you're looking to do. We want to figure that out. And then where? So identifying our markets. I'm going to go over this a little bit later, but not all markets across the country are going to make sense. So certain markets may provide a better specific type of return for you, whether that be cash flow, appreciation, a little bit of both. So we want to figure out, where we want to focus. And then last but definitely not least, introducing all the key players. So like I said, it starts with myself as an advisor, but there's a lot of really, really important people in this process, like our lenders, our real estate agents, our insurance folks, the property management team. So they are all, and that's what's really nice about working with a company like us at Marshall Reddick, is we definitely have a team element and a lot of good people to be able to help through this whole process. So what I want to do is break down our first milestone, which is the what. All of these factors are important to understand when figuring out what you're going to buy, although not everyone is going to have the same information, right? So, or qualifications. People qualify for different amounts. People are looking for different results. And as we team up, we can come up with the best approach for you, right? So it's common for me to hear people say, I'm looking for a deal, or I'm looking for a really good opportunity. Now that can look different for multiple people, right? So is it, price is going to be an important factor of what you're looking for, the property class, which we're going to go into more detail. Again, what type of property, the condition, right? Are you looking for a turnkey property where you can buy and basically just start collecting rent, so which is much more passive? Are you looking for something that may be a little bit more run down, where you can put some money in, kind of a value add? And then, it's just dependent on what is your level of participation and how you want to be involved. So next, we're going to go over setting your real estate investment criteria. So basically, if you look through here, these are going to be certain questions that you might want to ask yourself. Is it for long-term growth or income, or long-term wealth? Are you going to be retiring soon? What is your experience? What's your risk tolerance? Financing, right? That's a huge one, right? So people may have a lot of goals in mind, but let's say you have a specific qualification in terms of an amount. Those are parameters that we're held pretty tightly to. So yeah, 6, what can you afford, right? So and if you see this kind of colorful chart below, you're going to see these are our property classes. They start from luxury and they go all the way to D class. So different property classes provide different investment results. So as you can see on our screen, the higher the property class tends to come with the most appreciation. And as the property classes get lower, you're going to see an increase in cash flow. So towards that luxury side, more appreciation. Towards that C and D class side, more cash flow. We primarily focus in the A to C range, and I can explain a little bit further of why we focus on those as we move along. Now, looking at this property class, as I dive into this a little bit deeper, a key factor in understanding how we arrive at property class is determining your median home price, which is based on the metropolitan statistical area. It's based on a metropolitan statistical area that we've obtained from the National Association of Realtors. And I can show you guys where that can be found. We have an ebook that you can go and have a direct link to that. So it's a median price that we're focusing on in a particular area. Now, just to give you a real life example, this one will be easy, but let's just say the median home price per the National Association of Realtors is $100,000. So at 100,000, you're going to be at that 100% mark. So from 100,000 to 130,000, that would be considered an A-class property. So it all starts at that 100% mark. So from 100,000 to 80,000 would be that B-class property. And as you can see, the differences below. Now, I kind of touched on it earlier, but we focus from A to C. Now, the reason that we focus on the A to C range is because if you get into luxury, usually luxury properties tend to be priced significantly higher, and the rents don't always make sense for that purchase, right? So you're typically going to be buying a home that has a lot of custom features, and rent can only go so high. So you usually can't make sense of renting that out, at least from a cash flow standpoint. And then on the flip side to that, you have your D-class properties. On paper, those may look really awesome because they're really inexpensive. The rents are, going to be relatively in range of what, what the market bears. And because of that, your cash flow is going to be really good on paper. The reality is when you factor in your variable expenses, which are, maintenance and vacancy, and just the human element alone, those properties don't tend to pencil out towards the end of the year, right? There's a lot of cost and I guess headaches too that can go into those properties that make it not worth it. So that's why we focus in that A to C range. Now, and then just below, there's another chart which breaks down a few different percentages, and that's just when you're referring to multi-unit, the projections are slightly different as you get into 2, 3, 4 and plus units. So that's the breakdown below. So basically the Association of Realtors, that metropolitan statistical area map that I was just talking about, this is a snippet of our ebook and where you can find that. So if you're in a particular part of the country and you kind of want to see what that median home price is for your area, you can find this on our ebook. And I basically, this is automatically linked up to any property that you're going to review on our website. That median home price is already connected to that market. But I'm more than happy to show you guys where you can find this ebook. It's on our website, and definitely can send it to you if there's some interest there. As far as property classes, so there's certain things that we like to focus on when analyzing properties. These are things that are not easy to change or adjust. So just to break it down, if you look at some of the kind of the quick breakdown of from luxury to D class. So like I said, we focus in that A to C, but luxury class is typically your executive or business owners. A is professionals or white collar workers. B maybe middle managers or young adults, and then C, hourly workers were more blue collar, and then your D class, low income or even sometimes below the poverty line. So that's kind of a little demographic breakdown of what you can expect from a tenant standpoint. And like I was mentioning, there's things that are much more important and things that are not as important when analyzing a property. So things that are important, price point, cost per square foot, school district, crime rate. Those are all very important. The reason being is those things are hard to change, right? It's hard to change a neighborhood. It's hard to change a school district. Whereas things that are not as critical as what type of property, essentially, right? As long as it's in a good area, the age of the property, property size, and property condition. So these are all things that can be changed, right? If it's an older property, it can be updated. If it's small, you can add on square footage. And like I said, property condition, it can always be upgraded. So a quick a quick way for me to internalize everything that I'm throwing at you guys is, A, B, and C. So I associate A-class properties with appreciation. I associate C-class properties with cash flow. And then I associate B-class properties as like a blend of both. So that's an easy way for me to kind of remember what type of property I'm looking for and what kind of expectations I can have from that. Okay, so you're going to find a line item on all of our calculations that say variable expenses. These expenses we have no control over, but they are going to eventually happen. As any owner, some of you folks that already own properties, you know this definitely, and those that are going to get into this, you're going to learn this, right? Maintenance and vacancy are just part of the business, and we have basically maintenance, and there's an associated estimate for maintenance and vacancy based on that property class. So basically we have our A-class properties at 8% maintenance and vacancy, B-class 10%, C-class 13%. And then in that 5+ units, those parameters break down a bit differently just because of economies of scale, right? So as you get into larger units, sometimes the maintenance is a bit higher, and the vacancies, our projections are in line with single families, but the maintenance kind of picks up a bit. So it's just something we want to be prepared for. So as you can imagine, I'm going to do a quick vacancy just example. For maintenance, it's fairly simple, right? We're taking 8% of the gross rent or 10% of the gross rent, and wanting to put that aside for any maintenance issues. When vacancy, it's a little different, right? So like an A-class property would be at 8%. So 365 times 8% is about 29.2 days of the year. So about 30 days. Now, these are projections, right? This is I think we're pretty safe with these estimates, but there's years that it can be much lower than this. There's years it can be higher than this. I think if you plan accordingly based on our calculations, it's definitely, you're going to be on the safe side. So those that own properties already, you may be looking at these numbers and say, hey, that's a lot higher than what I factor in, and that's fine. We'd rather overpromise, and we'd rather just make sure that we're giving you that that buffer there. Okay, so regarding the ebook, so everything I just spoke about is detailed in our ebook, and it breaks down the philosophy of how we rate properties and what those ratings translate to our owners. So this is free on our website, and again, I can send it to you guys if you request, or there's a link below, and that's where you'll be able to find it on our website. Okay, so next we want to talk a little bit about where, right? So I think we can all agree that not every market in the U.S. is a good place to invest. So I want to go over some of the markets that we're in, and how we chose those markets. So some of the major factors of how we chose markets that we're going to go into are listed below, right? So we want a strong job market. We are looking for a strong rental demand. Economic diversity is important. Housing affordability, right? So we don't want to focus in areas that are just way too overpriced. Strong education is important. And then last but definitely not least, reliable property management. We're going to talk more about property management, but that's definitely one of the key factors. It's to maintaining, right? It's only about a 30-day process to buy, but you're going to be owning these properties for multiple years, so management is super important in that process. Now, to go over, I just want to kind of highlight some of the the markets that we operate in. So we operate in 16 different markets across 8 different states, and what you're going to see is some of these cities have a green box around them. So those are all cities in which Marshall Reddick has a physical presence. And what I mean by that, either an office or our property management team or real estate agents. So we have offices in Tennessee, Texas, Florida, California, and boots on the ground folks there. So some of the call, like I said, a lot of the calls start with somebody like myself, but ultimately we loop in the folks that are on the ground there that can give us a much better perspective of what's going on in certain neighborhoods and markets and things that are developing, and all the credit to them to be able to have eyes to make investing from across the country much more feasible. So I'm showing you guys a quick plot map here. So as you can see, this is a plot map of our properties under management in San Antonio and Austin. And as of recently, we have roughly 750 properties under management in just Texas alone, almost 2,000 in total amongst all of our markets. So the reason for me bringing this up is just to kind of show you a little bit of I'm going to talk about this in detail, but essentially where the downtowns are. So you can see like where San Antonio is there and where Austin is, but all of these little dots are where properties are located. Now, what you kind of notice is that a lot of the properties are located in the suburbs or outside of the major metropolitan. And I'm going to kind of go over a little bit more of the why in the next few slides here. So why buy within a major metropolitan? So why do we want it to be in a big city? Well, one, large tenant base. If you have high population, you're going to have a large tenant base. Diversification of employers, right? So these bigger cities tend to have more options for work, and you're not reliant on maybe one industry. As I touched on earlier, more selection for quality property management. You don't want to be dependent on maybe one company who kind of runs this whole town. As these bigger cities tend to have the best chance for future growth in population, as we see now, like a lot of people are relocating and they're going to these major cities. So it's good to be in close proximity to those. And these larger markets offer greater chance for appreciation, right? So that's the reason that we want to at least link to some of the larger cities. But like I pointed out earlier, it's not necessary that we want to buy like in the downtowns of those cities. And this is why we want to go more towards the suburbs. And the reason is the downtowns are a bit older, right? It's a bit older, maybe a little bit more rundown, even a little bit more expensive, right? So what we like to do is we like to focus on a lot of the suburbs outside of those cities, and they are more likely to attract families. They usually have better schools, lower crimes. The properties are usually newer, and it definitely allows a better path for growth. So we like, kind of the long-term buy and hold strategy. And with that, we feel like those surrounding suburbs offer that more steady long-term tenant than maybe some of the downtown properties. Now, each market is going to have different demographics, different employers, different info on them. So these data packets go into much more detail about those particular metrics. And most of the investors who are going to consider a market may find that valuable. So those are again on our website. The link is below. If you're in between or want to kind of weigh in on a couple of these markets, I'm more than happy to share these with you. We also have webinars, and of course we have our actual colleagues in those offices to talk to. But for those that like kind of reading and data, this would be a good place to dive in a bit more on particular markets and some of that info. Okay, So another really big step in buying is, how do you want to buy, right? So there's all kinds of ways. Here's a quick list below here. You have your conventional financing, which is above and beyond the most frequently used, I guess, method. You can use a cash out refinance or a HELOC. You can use private lending. You can do buy cash. You can use a 1031 exchange, which is when you're selling a property and using those proceeds to move to the next. You also have self-directed retirement account accounts that you can use. I want to quickly touch on, since conventional financing is typically the most common method, we do have a preferred lender we work very closely with, and I'm more than happy to share that contact if you guys are interested in figuring out what your pre-approval number is. I do want to go over just some basics so that when you're looking at properties, you can have a better understanding of how to prepare. So the minimum down payment for a single family or for a 1-unit property is going to be 20% down. So you want to make sure you at least have that. You're going to have closing costs as well. That can range, but at least, for the down payment, you're looking at a minimum of 20%. I know some of you may think like, well, I know I can put, less down. I've heard of 3% down or 3.5% down or 5%. And those are all true as long as you're going to be moving into the property. But when it's for an investment property, those down payments are increased. So if you are looking for multifamily, which is 2 to 4 units, that minimum down payment is 25%. So you're gonna have to bump that up a little bit. Now, one thing that I like to point out is, for those of you that have been on our website and have seen properties, our pro formas are gonna indicate for a single family home a 25% down payment, and for a multifamily, so that 2 to 4 unit, as a 30% down payment. Typically, that helps with the cash flow because the loan is a bit lower. Also, you sometimes get a little bit of a better bump in interest rate. So that's how the default numbers are set. But truth be told, if you needed to, if maybe cash was a little bit of an issue of meeting those price points, you can back that down payment down a little bit to these numbers that you see here. So 20% down for a single family and 25% for 2 to 4 units. Okay, so how do we measure the success of an investment? So there's 2 pretty common benchmarks when you're reviewing an investment property. So there's cash flow, and that's measured by a cash on cash return. And then there's appreciation, which is measured by your return on investment. And our return on investment has even a few more pieces to that puzzle, and we can go into that a little bit deeper, but those are 2 main factors that people are looking at, right? So as you get higher cash flow, you tend to have lower appreciation and vice versa. So there's kind of a give and take in this relationship, but there is also a lot of properties that do offer a nice blend. So if you kind of don't have a hard side to either, there's a home in the middle in many markets as well. So for our, this is a kind of a snippet of what our financial calculator looks like when you're reviewing properties. Now, this is interactive. So this is a very detailed calculator, and it basically covers any investment benchmark you would need to know. All of the fields, or most of the fields, are editable. And you'll see here on the right, there's a function symbol, which basically allows you to click on and see the formulas of how we came up with that number, right? So some of you are going to go through this, you're going to look at these numbers, and you're going to think, how'd that come about? And we do have the formulas so that you can help follow along for those of you that are interested in that as well. What we're going to do is we're going to actually take a look at a couple properties, but before we jump into looking at those examples, I want to just go over quickly the San Antonio appreciation trend here. So as I was talking about, basically earlier, you're going to see this kind of the chart below, which shows the property classes. So that median home price in San Antonio is at that 236 mark, right? So that was that 100,000 that I gave an example earlier. So now we're using a live example of San Antonio. So from 236 to 307 would be considered A class. 236 to 189, B 189 to 118, C. So you can see how that actually breaks down in real numbers. And we basically have on the right side, you're going to see, an appreciation trend over the last 25 years. And again, this data all comes from the National Association of Realtors. So one thing I really like to point out when looking at San Antonio is the steady increase year over year. I mean, from 1995, you're not going to see any, double-digit increases or double-digit decreases. It's very steady, very consistent, even in, some of the toughest years, right? 2008, 9, and 10. There was very little decline in San Antonio. It stayed really strong. So that kind of shows me that this is a market that can battle through some really tough real estate environments. As we move on, I want to show you guys for example, this is a new construction duplex in Seguin, right? So this is right outside of San Antonio, in between Austin and San Antonio. It's on the way to Austin off of the I-35. This would be a great example of a new construction property that, has done really well for our investors. So what you'll see here is you're going to see the list price of $439.9. Again, the down payment on this calculator is 30%. Technically, you could put 25 if you'd like. There's going to be no repair costs because it's brand new. And then, you have your estimated closing costs here. Again, those can vary a little bit. And then it comes with your investment capital needed. Our gross rents are $2,900. So again, that's a duplex here. So 29 for both units. Which is, $1,450 aside. And then what we're doing is we're going to factor in your mortgage, your taxes, your insurance, your property management fee, HOA, and then, there's going to be no utilities or landscaping payment for the owner. So what you see here is all the expenses come out to $2,392, and with that $2,900 in income, you come up with a monthly income of just over $500 a month. Now, those are all your fixed expenses. It's pretty typical to see that as the common income for the property, right? Especially for a brand new unit. Typically, you are going to have maintenance in vacancy eventually, and we do factor that in right below. So as you see, there's estimated maintenance of 5%, an estimated vacancy of 8%. We also have a leasing fee, which basically is when our property management team is placing tenants, the first month of rent, the leasing fee is 50% of that. So we would take that 50%, the rest would go to you, and then the rent, the normal income would resume moving forward. And that's basically for the work involved with placing that tenant, running background checks, touring the tenants, doing everything to get them in the property. Now, one thing I want to point out is because it's new construction, we have altered that maintenance down instead of 8% to 5%. Especially in the first, 5 or 6 years, everything is brand new. So plus there's builder warranty, so it's hard to really even have any maintenance, but we have to put some, it's smart to put some number in there. So when you back out the maintenance, the vacancy, and the leasing fee, you're left with a cash flow of $50 a month. Now, that's again if all of those numbers were to be accurate, right? In the sense of you were going to have maintenance and vacancy of 8% and maintenance of 5%. So again, for those that own property, you may be looking at this and saying, well, mine's much less, which means that if anything, your numbers are going to be better, right? So, and then down below, you're going to see your profit, and then the return on investment. And these are based off of the 15-year hold. So our profit is basically factoring in, cash flow, appreciation, principal pay down, and backing out your selling expenses if you were to sell. So this is under the assumption that, you're cash flowing for 15 years, you're letting the property appreciate, and then after you sell it and you back out all those expenses, that's what you should have. Again, that's off of 15 years. You can change this on our website version. This is a PDF version, but on our website version, you can change the years held or any of these numbers to reflect accordingly. So that's really fun. kind of way to examine and take a look and run, different analysis. If anybody is interested in, properties like this, again, please let me know. I will be doing follow-ups and we can get you connected with the right people. Okay, so next I want to go over the Cape Coral market. So same kind of deal, right? This is the appreciation trend for Cape Coral. You're going to see the chart above. You're going to see the median home prices there, and median home price in Cape Coral, Florida, 258 to that 336 is A, 258 to 206 B, and 206 to 129 is that C class. So very different on the right side, right? Looking at that appreciation trend, I'm sure you guys noticed there's a big spike up and a big spike down. So, I want to bring this to your attention as well. So you're going to notice this is a much different trend line. So this is one of the markets that got hit pretty hard in 2008. And I bring this to your attention to show that when you go, when you invest in real estate and you go long term, there's a very high probability you're going to make money, right? Even through, this crazy downtrend in 2008, those that were able to keep their properties are definitely back on track and making money. Not everybody had the luxury or was able to do that, but I guess the point of this is to show that when you are doing the long-term buy and hold, there is a very high probability of success. When you try to time the market and flip properties and things like that, it's just more risky. And there's more of a chance for failure. So as I wanted to point out though, there was definitely some pretty rapid appreciation growth leading up to kind of a big downtrend. And then as you can see over the last, over 10 years, we've had a really, really good run on appreciation. It's continuing to do so. Florida's been really booming for us. So just wanted to point this out, and we're going to look at actually a new construction Florida property as well. So this is actually a single family, and again, so the list price is $264.99. Down payment's 25. Again, if you really wanted, you can do that 20% down. We have 200 in for initial repair costs. You probably could put that to zero, and then you have your closing cost there. You have your gross rent of $1850. You're going to back out your mortgage, your taxes, your insurance, your management fee. This property doesn't have an HOA, and in this situation, we are factoring in utilities and landscaping for the owner. So with all of that said, it shows that you would have a monthly income of $331. Again, I reduced that maintenance to 5% because if it's new construction. Vacancy at 8%, and then the leasing fee. So that gives you about $40 a month. Now, one thing that we're not factoring in, and I didn't mention this in the last property either, is we don't factor in rental increases. So as everybody knows, as time goes on, rent goes up. So when you're factoring this 15-year hold, this is under the assumption that it's going to be at $1850 for 15 years. You can almost guarantee that anybody who is renting or has been renting for a long time has definitely seen a rental increase, especially in that long of a period of time. So that is not factored in, and it is something that we definitely want to make you guys aware of. So it's better to err on the side of caution in our opinion, and that's why we do that. So yeah, that's another, if you're interested in something like this as well, I know I gave you two examples of new construction. That just tends to be a good area to focus on right now, specifically because of there's a lot of competition in the market. When you go straight to a builder, you can cut out a lot of that, maybe submitting offers over asking. To a great extent, you're more in line with being able to just get the property at that list price and it's brand new, as opposed to battling for properties with multiple offers. We still have the ability to do that though. If new construction is not what you're looking for, we have our team that are definitely winning deals on the MLS. It's just, we want to make sure that we're setting the correct expectations and the game plan to go ahead and win these deals. So, yep, something to think about as you're, exploring options. Okay, so We talked a little bit about property management, but this is a this is the maker, in my opinion. Property management is the make or break element of an investment property. As I mentioned, there's only it only takes about 30 or so days, maybe less, to acquire a property, but it's where the real work is put in is the years and years of maintaining that property, dealing with the tenant, dealing with repairs, keeping it up to par, getting new tenants in, doing turnovers, right? Just keeping it on track. And that's all due to the credit of our property management team. So as you can see here, there's a little bit of a difference in terms of property management fees, very slight, but the breakdowns are below. There's basically two fees in our property management. There is a monthly management fee, and then there's a leasing fee. We talked about the leasing fee a little bit, but I'll go over it again. So there's a monthly management fee for any single family. It's going to be 8%. As you go into the multifamily space, it does start to decline. So it goes from 7 to 6 to 5 in Clarksville and in Tennessee and in Texas. In Florida, that 2 to 4 unit range is still at 8%. Now, the leasing fee again is 50% of the first month's rent, and that is meant to that is for the procurement of the tenant, paying the leasing agent and all of the expenses involved in vetting and screening that tenant. So that's how that breaks down. If you have any questions or more detail, this is also on our website. I'm more than happy to send that to you. You'll also see here there's minimums and maximums. So something to also recognize if you had maybe a smaller property or a larger property with large rent, or higher rent, you can factor that in as well. Now, one of the questions is what does property management actually do? So it's easier to say everything, but these are some of the line items, right? So fix up costs, making sure that the property's turned over quickly, rental analysis, advertising and marketing for the property, screening applicants is so important, right? We want to make sure we're getting good quality people, getting them to sign the lease, collecting the rent, the year-end statements, as I mentioned, right? So that we have a robust property management software that allows us to give you reports and year-end statements to make sure you're able to reflect that to your CPA or accountant at the end of the year. And then, conduct inspections. Now, all these seem, pretty much par for the course, right? But, full disclosure, the biggest reason that I would encourage someone to have property management is just to know the rental laws, right? To keep you out of court, to keep you dealing with a scenario that that you're maybe unfamiliar with, right? With the laws, especially if you're not familiar with that state or those rules and regulations. So rental laws are so important, and they're always changing, and we focus primarily on markets that are much more landlord friendly, but you still want to make sure you know all the rules and regulations. So that's the biggest takeaway, I would say. And I think there's probably some of you that manage property yourself, probably do a good job, but I bet you can agree that it is a lot of work. So for those of you that are just getting started or are going to be investing across the country, highly recommend using property management. Now, here is some of the features of our property management that sets us apart. So we only make money when you make money. So if there's no rent, there's going to be no charge. So if it's vacant or we didn't collect rent, we are not going to be charging you. We have outside vendors for all of our work orders. So there's no in-house maintenance. And the reason for that is because it tends to be a conflict of interest when you haven't, in our opinion, of course, when you have an in-house maintenance team. The reason being is if we have an in-house maintenance team and we go, the tenant asks for a repair on something, and maybe it's a quick little fix. It is if we're able to generate revenue through our fixing of things, what you will notice is maybe that the amount of times the property manager is fixing things tends to be more frequent than you'd like. I've experienced that personally. I own property outside of markets that we do property management, And I've noticed that myself, where there's an in-house maintenance team, and I've noticed that there tends to be a lot of maintenance issues that I'm not so sure that needs to happen. So you'll start to see things like that, and that's why we like to just use our trusted vendors. So we'll go out, we'll send those people. We give them a lot of business, so we have the utmost trust that they're doing their jobs accurately. But if it's something that's a high price item, for example, we're going to get multiple quotes. We'll get the best deal for you, and then you're going to have invoices attached, so you'll be able to see the cost directly. There's no markup, there's no coordination fee. It's all part of our service, but we like to make it clear that that's how we handle any kind of maintenance or repair items. And then proper software and tracking. So what you're going to notice is there is a lot of back and forth in terms of rent collection, rent disbursement, a repair here, maybe there was a late fee or something like that, and it's important to track all that. So having the proper software and tracking, database or apps is really important for you as a landlord and for us as a property manager to be able to reflect that to you guys. Now, there is definitely risks involved in owning property, right? So vacancy, maintenance, property values can go down, natural disasters, there's tons of things that can happen. But of course, with any kind of investment, there's risk. We definitely don't want to try to pretend that they don't exist, but we do a really good job to help eliminate that risk. And this is a good, kind of breakdown of how we do so. So, for vacancy, right? Sticking to a higher property class or places that have a high demand or there's a large population tends to help with that. If you're buying in a market where a lot of people are moving to and it's just a good place to be, you have to think, would I live there, or could I see myself living there, or would it be, could you see why at least people live there? Maybe you don't want to live there yourself, but at least you can see people living there. So sometimes, those are important to understand of why those property classes are important. Because you're dealing with, as you get into the better property classes, it's more desirable for people and it's more consistent. So for maintenance, right, it's all about making sure that we are buying properties that are in good condition. We do so by home inspections, maybe newer properties, or like I said, even new construction. So as far as property values, right, so they can swing a lot of times, regardless of how they swing. Like I was mentioning earlier, if you hold long enough, the trend has been that values have gone up. But making sure you're putting down 20 to 30% is going to give you that buffer, so that in the event of ever having to sell, or the chances of you being upside down on a loan is very uncommon, right? As opposed to back when the crash happened, where it was stated income and you can put 0% down or 5% down, or these ridiculous amounts down that kind of led people to over leveraging, right? So there's rules in place now that prevent people from doing that. But the more you put down, right, the typically the more manageable that payment is, and yeah, not as much pressure if there is property value swings. And then natural disasters, right? So there's things that happen that are completely out of our control. Proper insurance definitely is an important factor in this. So good insurance with roughly 500,000 liability is a good policy. You can always talk to insurance folks that we work closely with to kind of go over options and other policies to best protect you. But the best way to reduce all these exposures is ultimately good property management and a solid insurance policy. So these are things that are definitely at play, but with the help of professionals in the property management service like us, we're definitely be able to kind of navigate some of these pitfalls. So I wanted to kind of just, as we come to a close here, kind of explain us, you can almost consider us as a one-stop shop. So the conversations start with myself as an advisor. I can connect you to our lenders to get pre-approved, and then agents in the particular market. We then, get you looped in with, home inspectors, insurance folks, and then ultimately the property management team. So like I said, I'm one spoke on this wheel. There's a lot of people involved, and I would be kind of helping you folks through this process and introducing you to all the key players along the way. This is, one of our main presentations, which is the How to Buy Investment Property event. There's tons of other information or tons of other learning material that you can find on our website, as from, articles, quick, write-ups. There's the data packets we mentioned. There's tons of webinars. There's all kinds of just information that could be of value to you folks, and that would be all under our Learn tab. So you go to Learn and Education, tons of info that you guys can go through, and then ultimately, like I said, I'm going to be doing some follow-up calls after this. These calls can be as short or as long as you want. I'm here to help however I can. So if it's, you're ready to buy, this week and you need to get the ball rolling, I can help. If you're just kind of thinking about it, you want to ask some questions and, you don't even have a projected date in mind, that's fine too. It's helpful to kind of bounce ideas off of someone like myself, and can definitely help in any way, at least give you more info to do the proper due diligence, right? So whatever stage you're in, we can definitely assist. And then as far as you can connect, here at marshallreddick.com/consultation. Preferably, if you just you can contact me direct, which is right here. You see my email, vtomich@marshallreddick.com, or you have my cell phone number here as well. I'll leave that for a second. And by the way, this presentation is being recorded, so we'll be able to send this out to you folks if you wanted to rewatch it. So feel free to connect with us on social media, see what people are saying about us on Facebook, Yelp, Zillow, right? Lots of places to kind of look us up. But yeah, I wanted to thank you all so much for joining us. Again, if you have any more specific questions or things you want to discuss, I will be doing follow-up, or you can reach out to me and we can go over that on a one-on-one basis. But thank you guys all so much for your time. Really appreciate it and look forward to working with you all soon. Thanks so much.